Valens Research, Uniform Financial Analytics.
Seattle Genetics is incredibly powerful because it highlights one of the other big issues with as-reported accounting metrics. It incorrectly represents directionally how profitable a business is. Look at this, Seattle Genetics. If you looked at Seattle Genetics, what I just did here is I took you to the Uniform Accounting EPS to as-reported EPS tab, where we show you what the real EPS, what the real earnings of a business are relative to the distorted as-reported earnings. Right, for Seattle Genetics, unlike a name like, say, Marriott, you might think, hey, it's a profitable business, but it's not that profitable. If you look at, one of the other companies that we highlighted earlier, you look at S&P Global, you'd say, hey, it's a very good business, but they don't realize how good it is. With Seattle Genetics, literally, you are directionally wrong in terms of how profitable this company is if you're looking at the as-reported accounting metrics. You think this company is hemorrhaging money when it's not. You think this company is a startup, right? A company with negative ROAs, that's a biotech company desperately trying to find a product to come out with. But in reality, their returns have been positive since 2012. They're not losing, right? $1.40 a share. They're actually making, right, 90 cents a share, right? This is how wrong the as-reported accounting metrics are for this company. They are telling you directionally wrong data. And why is that? Let's take a look. This impact of adjustments tab actually shows us why the as-reported accounting metrics are so distorted. And for Seattle Genetics, look at the biggest reason why. When you think about research and development, R&D, right, it is one of the most problematic numbers in the income statement and in the financial statements in general today. You step back and think about it, right? The net income of this company is negative $230 million, $220 million. That's because of the fact that this company is massively investing in R&D. Is that a bad thing? Is that actually a thing that's negative for operations? Of course not. It actually has, in a weird way, it has nothing to do with operations today because of the fact that it's an investment in tomorrow. It's an investment in the future. Right? One of the core tenets of accounting is this idea of the matching principle. You should match the expenses that you have. They should actually be recognized in the income statement at the same time that related revenue is. When you get a biotech or a pharma company that's investing in R&D, is that R&D for a product that's coming out this year, let alone this quarter? Of course not. That's R&D investment for a product that might come out in 7 to 11 years. Why are we expensing that R&D today? Right? And so that's one of the core things that we highlight here is what we're doing is we're actually capitalizing that R&D. And then just like we do for PP&E, right? If you build a whole entire factory in one year, all that doesn't show up on your income statement this year, right? That shows up on your balance sheet because you invested. But then for the life of that factory, be it 20 or 30 years, you depreciate down the value of that factory, that investment that you made in front end. We should be doing the same thing for research and development. If the average life of $1 of R&D for a pharmaceutical or biotech company is 11 years, we should capitalize that R&D for 11 years, and then we should amortize that R&D over its life cycle to better reflect what the real operating returns of the business are, and then what the real investments are for a business. And we can see here for Seattle Genetics is they're investing massively in R&D. We as investors, we should be excited about that. That means more innovation coming. That doesn't mean they're a negative cash flow. That doesn't mean they're a negative earnings business. That means they're a positive earnings business, right? Throwing off $140 million a year, that's investing in the future. And that's what's so important is as-reported metrics don't correctly reflect that because they don't correctly reflect the real accounting reality of a business. And that's why this business that actually has positive ROAs looks like it has negative ROAs and negative EPS.
Valens Research, the world's leading source for uniform financial analytics.